Hello, this is the example problem on problem. Already we are discussed for this problem on journal entries in the books of whatever was transferer company means here given balance sheet is related to X company anna. Earlier we are already discussed about this one anna. So some of the equity share capital principles, some of the liabilities they are given at here, some of the assets also they are given at here anna. Right, at liability side equity share capital 10 lakhs, preference capital 2 lakhs, etc is there. I will send this one to you Nanna. Okay, right. So on the about it X company limited when business was purchased by Z company limited, and Z is newly registered company, right, with the following terms and conditions Nanna. Number 1, all the assets are assets of X limited taken by Z company limited except motor car. Here so many assets they are given. Building they are agreed to take, furniture also they are agreed to take, plant machinery they are agreed to take, stock they are agreed to take, debtors they are agreed to take, bills receivable they are agreed to take, what I call cash at bank also they are agreed to take, except this motor van. Also, if given or not given in the question, if in the if specified or not specified in the question anna, so preliminary expenses, discount on shares, discount on debenture, underwriting commission, such type of any names are given in the old balance sheet. This one at any cost don't what I call not agreed to take by the new company anna. That's why this is non takeover assets from the old company to new company by the new company. This is also they are not taking motor van also. That's why except this one and all these values remaining all assets agreed to take by the new company with the new values with the new values. Building they are agreed to with agreed to take 5 lakhs. Furniture they are valued as a old value book value means old value what given at here 2 lakhs. Next one plant and machinery they are agreed to take 2 lakhs. Stock they are agreed to 60,000. Debtors also 190. Next bills receivable 90. Addition to that this cash also they are agreed to take. Assume yourself. Here remaining these all assets they are agreed to take with the new values. Cash at bank always they will take they can take with the balance sheet value only. Next motor car was sold by old company. Old company they are selling to outsiders It is not taken by the new company. Next except bank loan. Here at the liability side debentures are there, creditors are there, bills payable, outstanding GST there, bank loan is there. Out of this all outside liabilities except bank loan, remaining all liabilities agreed to take by the new company. Okay, so these reserves as well as capital we should transfer to the equity share capitals of old company equity shareholders That's why don't what I call pause any journal entries in the books of new company. Right Nana. Next one, another one. Except bank loan, all liabilities are taken by the Z company limited, and X company paid bank loan. Right, they are paying directly. It is paying by the old company, not by new company. Z limited was agreed to pay purchase consideration on equity shares of each 100. But how many shares they are now giving Nana? How can we know that one Nana? After calculation of the please calculated working notes, how much amount payable as a purchase consideration, and how much amount will come, that one please divide with 100, we will get the number of equity shares. Liquidation expense incurred 40,000. This one also paying by the old company, not by new company. Show the journal entries and ledger posting in the books of X company. This is already our previous class. In the previous class already we have discussed about this one. I am sending all the video. Now I am asking as a example 2 Nana. For the same problem I am asking example 2 Nana. Pass the journal entries in the books of transferee company means Z company books for the problem number 1. Problem number 1 means example number 1. What balance sheet given in the example 1 based on that all the information they are asking journal entries in the books of new company. So it is the answer from here onwards answer right. So journal entries in the books of Z limited. First entry for the purchase of business we are required to pass first journal entry. So debit the business purchase account. Why? Because purchase is one of the expenditure. That's why they are debited business purchase capital expenditure. They are debited the business purchase account with the purchase consideration. At the working notes already we are calculated. At working notes already we are calculated amount of the purchase consideration by adding all the takeover assets. We are deducted takeover liabilities remaining purchase consideration. With this how much will come here Nana? With this amount we are required to pass first journal entry in the books of First journal entry in the books of transferee company, right? Vendy company. First one, debit the business purchase account. Business purchase account it are two. This amount is payable to the X company, Nana. So at the time of liquidating by the any company, Nana, one person will appoint that person name called as a liquidator. That's why the amount is payable to the this official person or liquidator, Nana. That's why debit the business purchase account, create the liquidator of X Limited. Okay, with the 14 lakh 5,000. Being business was purchased from X Limited by Z. Now Z company, we are the Z company. We are purchasing business from the X. That's why being business was purchased from the X Limited with the purchase consideration 14 lakh 5,000, 14 lakh 5,000. After that, Nana. So what assets we are taking from old company, what liabilities we are taking from old company. So to take when we are taking these liabilities and assets, Nana, to record the such type of all things, Nana, in our books, one more entry required. Debit the building account. Why? Because we are taking debit the furniture, debit the plant, debit the stock, debit the debtors, debit the bills received, debit the cash. Don't debit the motor vehicle. Why? Because motor vehicle we are not taken from the old company. Leave it. Don't debit the fictitious assets like criminal expenses, discount on shares, discount on debenture, underwriting commission. What are given in the old balance sheet? That one also leave none. Don't consider it here. Now what assets we are taken from the old company? That all assets debit with all the new values. These all values are new values, not a agreed values. These all values are agreed values, new values, not a balance sheet values, book values. Okay, right? Create the what liabilities we are taken from the old company. Next, 6% debenture, 2 creditor we are taking, 2 bills payable we are taking, GST we are taking. Create with the business purchase. How much amount we are debited in the first entry on the name of business purchase. Again, these all assets coming in the part of business purchase. That's why I am created business purchase account 14 lakh 5,000. In generally, this total amount of the debit agreed with total amount of the credit. If any difference will come, please show as a equivalent of goodwill account on the name of goodwill account at here. How much difference will come at here? The difference please write as a goodwill. If difference will come at credit, Nana, if all the debits are excess is there compared to credit, Nana, some difference will come at credit. Please write as a general reserve. General reserve. If debit difference will come, debit the goodwill. Credit difference will come, credit the capital reserve. Capital reserve. In case of pooling of interest method. In case of pooling of interest, purchase method. So to pass the journal entries in the books of new company, there are two methods are applicable. Purchase method, pooling of interest method. In case of purchase method, when difference will come at debit place, please write as a goodwill. In the pooling of interest method, please write as a general reserve. When difference will come at credit, so under the purchase method, please write as a capital reserve. So if it is the pooling of interest method, please write as a general reserve. Narration being various assets and liabilities are taken from the X company limited with agreed values. Here we are taken debentures. Sometimes what debentures we are 6% debentures we are taken from the old company. After that, sometimes these debentures by the cancelling these old debentures, 6% debentures, new company will can allot new debentures like 8% debentures, etc. In that case, one more entry required. Debit the 6% debentures, old debentures account. Credit the 8% debentures if we are converted as a 8% debentures. But in this example question, they are not converting old debentures in the new debentures. That's why I am not taking any amount set here. After taking the debentures from the old company, sometimes new company will convert, can be convert as a new debentures. In that case, for the cancellation, debit the old debentures, credit the new debentures. Year 6%, year 8% approximately, or year 6%, year 4%, whatever it may be. Okay, if applicable this and the applicable that type of conversion, please pass this entry. Please show the entry, this entry, third entry. Otherwise, don't pass this entry. After that, fourth entry. Now, what amount we are agreed to pay as a purchase consideration? What amount we are agreed to pay as a purchase consideration to liquidator of X company, that is 14 lakh 5,000. Now I am discharging, I am paying this amount of 14 lakh 5,000 to the liquidator of the old company. For that, one more entry is required. Debit the liquidator of Z company, X company, liquidator of X company. They are the receivers, 14 lakh 5,000. Now this amount we are paying in the mode of equity share capital. Create the equity share capital. Now we are allotted 14,050 shares, each one 100, to the liquidator of X company, right? To pay the preference share capital shareholders amount and to pay the equity shareholders amount. So how can we know this 14,015 Anna? Already we are discussed in the earlier class Anna. Right? Total purchase consideration according to our working notes here 14 lakh 5,000. This 14 lakh 5,000 they are agreed to give each one 100 rupee share. 14 lakh 5,000 divided by 100, allotted shares value 100 nana. So remaining number of shares will come 14,050. These number of allotted shares I am taken in this fourth entry. Debit the liquidator of X company, create the equity share capital with the number of allotted shares 14,015 to 100, 14 lakh 5,000. By the passing these four entries, right? So general entries in the books of transferee company completed nana, right? Being rupees 14 lakh 5,000 purchase consideration was paid in 14,050 equity shares, each one 100 in the part of purchase consideration. By the passing these four entries, in your whatever our problem will should be complete nana in the books of transferee. After the sometimes they can ask on new balance sheet in the books of Z company. But here I am not asking. Why? Because winding up companies are not given two nana. In general, in the amalgamation, two or more, by the winding up of the two or more companies nana, we can form the new company. So here I am taken only one company as a old company, one company as a new company nana. That's why what I call that is merged balance sheet is consolidated balance sheet is not required to prepare it here. That's why leave it now presently nana. Okay.